Welcome to the MTA Podcast Series, a weekly audio cast featuring interviews with recognized industry professionals. And your host, Ed Carlson.
Tuesday, January 19th, 2010. We have a very special podcast today with a very special guest. From 57th and Lexington in New York City, today's guest is Tom Keene. Tom Keene is editor-at-large for Bloomberg News, where he provides economic and investment perspective to Bloomberg's various news divisions. Tom is the host of Bloomberg on the Economy and co-host of Bloomberg Surveillance, heard weekday mornings on Bloomberg Radio. Tom is the editor of Flying on One Engine, the Bloomberg book of master market economists' 14 views on the world economy. He is a chartered financial analyst and a member of the CFA Institute, the National Association for Business Economics, and the Economic Club of New York, and a graduate of the Rochester Institute of Technology. Tom Keene, welcome to the program.
Well, great to be with you today.
We're just delighted to have you. You know, I've been a longtime listener of your podcasts, and indeed they've actually provided a model for me to help us get started here at the MTA. But I've always wondered, were you a media guy who did his homework and turned to economics, or are you an economist who ended up in the media? Give us a couple minutes on, what you majored in at RIT, sure, and what transpired between then and your time at Bloomberg Radio.
Well, long ago and far away. First of all, I'm not an economist. It's something I correct all the time. I look at the phrase economist as somebody that's at least got a parchment in economics, which I don't have. But, to go back, I started out ages and ages ago, literally being 4 and 5 years old, and watching my mother and my grandfather do technical analysis, particularly point and figure charts. Oh. And from my earliest memories, it was about John Maggie, and it was about all the point and figure heritage that we know from decades ago. And then that folded into a study of economics that started very, very young, and then into RIT where, actually before that, aerospace engineering at Colorado, and then to RIT where I took a degree in biology and microbiology. But within that, I just kept studying economics. It was just something I loved to do. And then to make a long story short, to the CFA program and all that. And I am taking courses now at the London School of Economics, which I love very much. I mean, I just love, actually going in and looking at the rigor that we associate with LSE and, the math and all that as well.
Mm-hmm. Mm-hmm. Well, we're going to get to economics in a couple of minutes, but before we do, I still want to talk about what you do at Bloomberg. I listened to your podcast and I've come to the conclusion, what is it that makes these interviews so special? And I've come to the conclusion that what separates you and your interviews apart from everyone else is that when you make references to names like Schumpeter and Hayek and your comments like C plus G plus I, et cetera, it starts lighting those synapses in my brain that haven't fired up since business school, and I start to feel like I'm a part of the interview and I can relate to your questions. Well, talk to us about the process of finding your guests for your program and the preparation you do for the interviews.
The way that we structure the program was out of necessity. First of all, there's no way we could do these programs today without the modern technology of the Internet and of the search engines on the Internet, the way we go in and find the different research work. I've got a terrific team that works with me, and, we're doing it every day, and we're doing 4 and 5 and, 6 different interviews a day sometimes. And in doing that, there's a process to making it happen. Overlaying that are the core beliefs that we had from the beginning of these projects when I sat down with Al Mayers, the executive editor of Bloomberg Radio, and with the great support of Matt Winkler, in linking economics to the history that's involved. If I've heard one thing from the guests, and particularly the more famous guests, it's what they like about the show is pulling in the history. Economics has become very ahistorical in the last 10, 15 years or so, and we're always trying to pull in the linkages to the past that enrich the present and maybe give us a little bit of a glimmer towards the future. It's true that I do read a lot of it. I mean, it's one thing to talk about Joseph Schumpeter And it's another thing to actually sit down and read his 1948 address to the American Economic Association, or to read Thomas McGraw's wonderful one-volume Profit of Innovation. But, it's one part a lot of good research, and it's also one part just the structure of the program, where we're trying to link economics with history and with a little bit of math as well.
Mm-hmm, mm-hmm. What does your typical day look like? Can you kind of take us through a day at Bloomberg?
It's top secret because it's so ugly, but
got it.
The answer is it starts in the morning, and I go in by car to Bloomberg, reading in the car, starting the newspapers, which now are really almost all off the Kindle, and then I keep reading the newspapers at work, and we get the show going. Rebecca shows up, and then Emily shows up right after Rebecca, and it's very task driven, and we're very, very busy. We've all got things that we're doing as we get to 7 a.m. and the beginning of Bloomberg surveillance. And then we're going through the 3 hours of Bloomberg surveillance, and while we're doing that, they're preparing for Bloomberg on the economy, which we typically tape midday. And in the middle of all that, I may have TV here or TV there, or print meetings and such, project meetings with the rest of Bloomberg LP. And then the afternoons quiet down a little. I try to leave our world headquarters here at 4 o'clock or 4:30, and the dirty little secret is, and then the day starts with doing reading at dinner. A lot of times, a lot of the preparation that you see, particularly for Bloomberg on the economy, is occurring at sit-down meetings at dinner. So it is a very long day, but, I've been fortunate enough to be able to do this where, I'll be honest, there's not that much pain to it. It's not a lot of heavy lifting.
I like the idea of a driver taking you to work, and so you can then start to read the newspaper. That sounds like a great job.
It's really, there's a real concision to this. There's a real, and this is true of a lot of other people in the media. I mean, a lot of the recordings and the cut-ins, it's all very, very efficient how we do it. It's where every second's taken, and people are moving me around to one recording studio or the other to do things, or dashing off to do TV quickly. But that's true of all of the media. The making of the sausage is a little bit ugly.
Yeah. Oh, that's great. Well, we feel very fortunate that you made time to spend a few minutes with us this morning. We're going to continue with Tom Keene in a moment, but first a reminder that include Jake Bernstein, Dennis Gartman, Chris Verone of Strategist Research Partners, Katie Stockton of MKM Partners, and because one guest from Bloomberg just isn't enough, and because Shane wants to record one of these interviews at home with a martini in hand, from Hong Kong, we'll have Bernie Lowe. Tom, let's switch gears here and let's talk economics. Economists like to talk about the various shapes of a recovery: V-shaped recovery, L-shaped, hockey sticks, and of course they snicker at terms like head and shoulders and triangles. Time heals all wounds, but it usually leaves a pretty big scar. Given all the research you read and all the great economic minds you speak with, let's talk about some of the conclusions you've come to and have the green shoots turn to garbage shoots. Let's start by talking about credit contraction. We had news this morning that the bank lending was down again as of January 6th. Some say banks don't want to lend. Some say businesses, particularly small businesses, don't want to borrow. Well, who's right? And what's it going to take to get this economy back on the gravy train?
They're both right is the answer. I have trouble suggesting we're in a liquidity trap because we really don't have the persistent price decline, aggregate price decline and deflation that usually is identified within a liquidity trap. But very certainly within credit demand, we've got ample credit supply, which is a major indication of a liquidity trap. Mm-hmm. And we do have a very, very tepid credit demand. There's no question that has to turn around, and you overlay on that sort of the surprise in business investment over the last 5 or 6 years, the fall off that we've seen in business investment growth, and it leads to a real lack of animal spirits away from consumption. There's no question that one of the great divides between the optimists and the pessimists out there is how we're going to jumpstart business investment. Right now, the optimists are looking at good third quarter growth. There's a clear understanding of a very robust fourth quarter, And the optimists look further on into 2010 and see that in some forms continuing. Most of that is based on an inventory rebuild, and then it's based on a jump-starting of business investment. And I would say that's one of the great points right now. And within that is credit availability, particularly to small business. I would say that one of the major ideas here is this idea of the disparity between big companies, big visible corporations, much more attuned to the payroll numbers, and the small business group, which is much more within the household survey, and within credit demand and the supply of credit too, the focus right now is on the small business people. There's no question, the optimists and the pessimists, everybody is just riveted on these smaller businesses under 500 employees within America.
Let's move on to real estate. You recently spoke with Carl Case and Robert Shiller, the minds behind the Case-Shiller Index, after their most recent release, and I wouldn't say either of them sounded terribly bullish. And of course, everyone's talking about a coming shoe to drop in commercial real estate. What should we be watching for here? And what about the shadow inventory of foreclosure properties?
Yeah. It's an incredibly important question. First of all, one of the great things about the show is if you listen enough, you begin to get the real nuances of the guests. And we definitely had a sea change with the latest Case-Shiller statistics with Carl Case at Wellesley and Robert Shiller of Yale. And it'll be really interesting to see how Case-Shiller looks. That's, I believe, coming up next Tuesday. And within that, I would say Carl particularly is worried about what you talk about, which is foreclosures on foreclosures. And they're also worried about the coming challenges in real estate as you go up the food chain. There's no question we've had subprime issues, but now going into 2010 and even into 2011, there's the idea of challenges in the mortgage business within middle-class housing and even within expensive housing, more from economic slowdown than anything else. But yeah, you're right. There's been a real nuanced change with the latest housing data, and it's absolutely critical to see how that develops, not even so much this month, but say over a 3-month period. And the jury is really out on that as we go into, say, February or March.
Well, speaking of nuances, let's talk jobs for a moment. I remember before the December jobs report came out a couple of weeks ago, everyone was all excited that they thought December was going to be the first up month since the recession started. And lo and behold, what happened, of course, was December was down 85,000 jobs, and yet the report left everyone scratching their heads because November was revised upward and it became the first increase in jobs. What do you think? Have we turned the corner here or not? Is it still a lagging indicator? Is it a leading indicator? What's happening here?
Well, textbook 101 is it's a lagging indicator. The labor economy is a lagging indicator, and there's some discussions about leaving it there, but then also tilting it at the same time towards being a more coincident indicator. But the jobs numbers, I think everybody, I'm as guilty of this as anyone, focusing on monthly data is really hazardous to your health. There's a great tendency, when the numbers come out at 8:30 for both myself and Ken Pruitt to go to 3 months moving averages to just really try to smooth out the non-farm payroll data and also the household data. And unfortunately, when you do that, it's still a pretty difficult picture. And then you get into, it's a lot like technical analysis. You can do whatever you want with a chart, and you can look at, first and second derivative looks at the curve. What I would suggest is there are a number of elements of the labor economy that show the path to stability that you need before you get into growth. You've got to get stable in labor flows before you get into growth flows. And what happened last month was a real setback just on getting to stability. And again, I think it does indicate that, one, we're seeing much less carnage on one side of the flows, which is actual layoffs, but two, we're not seeing the jump start yet that you need to see to get the labor flow stability. All in all, and again, there's different opinions on this, you get to an exceptionally challenging labor economy. Bruce Kasman at JP Morgan this week talks about essential growth, and his point is unit labor costs have come down enough where they'll actually be hiring when there is hiring, because people are making less. Well, that only gets you so far. Mm-hmm. But all in all, I would say that, yes, the job report was a real setback from the optimism of the month before, and the next caution then would be to take it and look at a 3 and 4 month smooth average, which means, the proverbial, we got to wait and see for more data.
Mm-hmm. Mm-hmm. It almost takes me back to a comment you made earlier about animal spirits, and it seems like without those animal spirits, we may stop the fall, but we just can't get this thing turned around.
Yeah, well, this is a big point within my work. There's a tradition which has drifted away a bit in the last 12 months, but I'm a big believer in nominal GDP analysis, and I'm beginning to see a lot of economists that were really stuck on real GDP, price-adjusted real GDP, folding in more nominal components, more immediate, more current components into their real GDP statistics. And the fact is, we feel so lousy because the current statistics are pretty bad. And one of the great hallmarks here is in some form getting the nominal statistics and the price-adjusted statistics to both go in the right direction. And we're not there yet. I mean, we're definitely getting great GDP, but then you immediately drift away to other statistics, and they're not so good.
Mm-hmm, mm-hmm. You know what? In our last 3 minutes, let's move in and at least touch on something to do with technical analysis.
Sure.
Let's start by talking about sentiment. That'd be a good transition. Technicians love to talk about sentiment, and economists actually spend a fair amount of time on the topic as well. Recent polls, such as today's NAHB poll, the NFIB Small Business Sentiment Index, they seem to be telling a different story than either the markets seem to be following, or even most economists, or at least many economists. How do economists decide? We're gonna listen to this poll and ignore this poll.
Right.
How do they make these decisions? Do you have any insight into that?
Well, I'm not very big on sentiment surveys. They become more important recently because they got so washed out. We're all looking for turnarounds in consumer sentiment. I tend to go beneath the headline data and look at some of the sub-data. But I will say this about technical analysis, in that I'm a very big believer in trend-based analysis, less stochastic, like I don't do much with MACD, just as one idea. Mm-hmm. And within that, I think there's immense value to finding given investments where you get a real washout, where you get sentiment so narrowed into a blah, to what I call soup, whether it's ADX, DMI, or it's a moving average study, whatever. But there can be a lot of value to finding trends that aren't happening. It's not so much looking for the trend as it is finding the things where the trend is just washed out and you've got the first derivative of say ADXI just washed out below 20 and down it goes. And then when you see that washed out listlessness, then seeing based on economics and fundamentals which way the trend goes and then climbing on board that trend. And so within what we call red zone, green zone, within point and figure charting, to find that washed out trend, I think is something people don't spend enough time looking at. And then within that, you wait for it to go before you climb on board.
Well, what you described as a washed out trend, it sounds to me like you're almost talking about, you're looking for, periods such as now where volatility has contracted to such, unreasonable degrees that then you look, and then of course the challenge is, well, which way is the breakout coming, and is the initial breakout a false breakout, et cetera, et cetera, et cetera. I listened to your December interview with Louise Yamada,
Sure.
And it sounded to me like you'd seen the light and you were ready for the level 3 CMT exam. And today's discussion doesn't change my mind on that. I chuckled. I was out for a walk listening to you on my iPod, and after you guys were wrapping up, Ken Pruitt said that if you didn't stop it, he was going to beat you around the head and shoulders. I didn't even know if he was making a joke intentionally or
no, I think he was missing the point of the head and shoulders. But we make a lot of jokes about it. But I'm a very, very big believer in a blended approach. Back, John Murphy and those kind of approaches of looking at economics, fundamentals, and technical all together. But the one thing I would say that's very, very important is this idea of it's not what you do, it's what you don't do. The type 2 construct within technical analysis is just everything. And one of the great, great virtues here of technical analysis is not so much getting you into trouble, but keeping you out of trouble.
There you go.
About keeping out of stupid trades or, I can't tell you the number of investments I avoided screwing up where technical analysis saved me because, trends were breaking down and there just was nothing going on.
That sounds like a great way to leave it today. We really appreciate you making the time for us today, Tom. Is there anything else you'd like to mention before we go?
No, I just think everybody should learn point and figure charting. The value of having no time function on the x-axis, I can't overweight that enough.
Yeah. Oh, that's great. Thanks, Tom. All right. So that wraps up today's MTA podcast. From Seattle, I'm Ed Carlson. You can follow me at seattletechnicaladvisors.com or contact me at ed@seattletechnicaladvisors.com. Send us your comments and suggestions. We really want to hear them or read them. Let's keep our stops tight. Good day.